Welcome, everyone. Glad you could join me for this explainer. Today, we are really going to get into the weeds of ESG strategy. We're going to move past the 101 level stuff and look at how these core investment ideas are being seriously challenged and, frankly, completely reshaped by the way our markets are changing right now. So let's just start with the question that I think is on every practitioner's mind. Are we just riding a powerful trend, trying to align our portfolios with these massive ESG tailwinds to capture returns? Or are we trying to drive actual, measurable change? In this space, the answer to that question really defines everything that follows. It dictates your entire strategic path.
All right, so to unpack this, let's start by drawing a really sharp line between two approaches that get talked about a lot, sometimes interchangeably, but they're just fundamentally different. We're talking about thematic versus impact investing. First up, thematic investing. This is all about spotting those huge, long-term shifts happening in our world. Things like the clean energy transition, the global need for fresh water, or innovations in healthcare. The core idea here, let's be clear, is financial. It's a bet that the companies best positioned to tackle these massive trends are going to be the ones that outperform in the long run. It's really about catching that sustainability wave. Now, impact investing, this is where the game changes. Here, it's not just about riding a trend. It's about intentionally causing a specific positive outcome. And a key word on this slide, the one I really want you to focus on, is measurable. This isn't just about a warm, fuzzy feeling. It's a dual mandate. You have to track your non-financial impact, the tons of CO2 you've helped avoid, or the number of kids who got access to education with the same rigor you track your financial returns.
And this table just lays it out so clearly, right? On one side, you've got thematic, where the main goal is generating returns from ESG trends. But the risk? You could get caught in a hype cycle, or you might struggle to find companies that are a pure play on that one single theme. On the other hand, impact investing is all about that intentionality and measurement. The big challenge there isn't finding a trend. It's proving, actually quantifying and verifying that you made the impact you set out to make.
Okay, so we've got these two active strategies. But here's the thing. They're running straight into a massive wall, a truly market-altering force, the huge tectonic shift towards passive, index-based investing. And when I say huge, I mean it. 16%. That is a slice of the entire U.S. stock market now held by indexed funds. We're talking about trillions with a T. Trillions of dollars that aren't being managed by a person picking stocks, but by algorithms that are simply built to copy an index.
So this leads us to the billion-dollar question, or really the trillion-dollar question. How on earth do you apply ESG principles, which are often about deep dives, qualitative judgments, and hands-on engagement, to an investment vehicle that is designed from the ground up to be completely hands-off and rules-based? I mean, this is without a doubt one of the biggest puzzles we're trying to solve in ESG today.
So what's the solution? Well, the first part of the answer isn't about changing the fund itself. It's about changing the recipe. You have to go back and re-engineer the very index that these passive funds are designed to follow. And there are basically three big ways to do that. The most straightforward is exclusionary screening. You just kick out entire industries like tobacco or thermal coal. A little more sophisticated is the best-in-class approach. Here, you keep all the sectors for diversification, but you only include the companies with the absolute best ESG scores in each one. And finally, you can apply thematic tilts, where you systematically overweight the companies that are doing good work in areas like renewable energy. But, and this is a big but, there is an unavoidable trade-off here. The second you start messing with an index, you introduce something called tracking error. It just means your new shiny ESG portfolio isn't going to perform exactly like its parent, like the S&P 500. Now, that's not always a bad thing. In fact, it might be the whole point. But for a product that's sold as an index fund, it fundamentally changes what it is. And check this out, because this is where it gets really interesting. Look at the ripple effects. When you decide to exclude a sector like fossil fuels, which tends to be very value-oriented, right? That money has to go somewhere else. So the index automatically rebalances, and all of a sudden you find yourself overweight in sectors like tech and healthcare. So you see, it's not just an ESG decision anymore. You've just made a huge factor and style tilt in your portfolio, and that completely changes your risk and return profile.
Remaking the index is a really powerful tool for sure, but it's not the only one in the toolbox. For these passive investors, there's another lever that becomes unbelievably important, and that is stewardship. Stewardship is basically the idea of being an active owner. It's about using your rights as a shareholder to actually influence how a company behaves. And since index funds can't just up and sell a company they don't like, their main tools become engagement, picking up the phone and having direct conversations with management, and proxy voting, using their massive voting power to support or oppose shareholder resolutions.
And this brings us to this critical concept of the permanent owner. It's so important to get this. If a company is in the index, the fund has to hold it, period. They can't just divest. But what sounds like a weakness actually becomes a huge strength. Because they're stuck with these companies for the long haul, their most powerful strategy for managing risk isn't selling, it's engaging. It's pushing for those ESG improvements from the inside. And look, this isn't just some nice theory. We have the data. The academic research is piling up, and it shows that effective stewardship isn't just about values, it's about creating value. Active shareholder engagement on the ESG issues that really matter has been shown to reduce a company's downside risk. That protects the long-term investment for everyone.
So all of this leaves us with a really powerful and I think provocative question to think about. As passive investing keeps growing, as it becomes the default way that global capital is allocated, has stewardship, the simple act of being a responsible, engaged, and permanent owner, has it quietly become the single most critical ESG strategy we have? Something to think about.